Finally got a little bit of a deeper pullback today in the market, just really a couple 3% off the recent highs. But what's your read on what's driving today and whether the market, with its defensive shift that's been happening under the surface, has already kind of figured out we're in slowdown mode in the economy?
Yeah, Mike, I guess first things first, I would say we're not surprised at all by the move today. We literally just pulled more money out of equities last week, starting with small caps and moving up to mid caps and then even a little bit out of large caps and moved over into fixed income because we just couldn't figure out why the market was trading at 41.50 with all the risks that were out ahead of us, with all kind of the negatives that we foresaw. So from that standpoint, I think it's all the usual suspects, right? It's been the leadership thus far. So you've got tech, you got energy, you got financials, all kind of coming back to the forefront with respect to how do they work in a market that needs to discount a recession. And oh, by the way, you've got these risks like the debt ceiling still, kind of lurking out there.
Sure. I guess the counter to that would be for all of the choppiness in the economic data, we've still been, clicking around a 2% real GDP rate. You have nominal growth better than that. The Fed looks like it's poised to pause relatively soon, unless you think that's not going to happen next week.
It's not so much that. We do expect 2 additional hikes, so we are a little bit out of consensus. We don't think they're done next week. I think that being said, if you look at history and kind of use it as a little bit of a guide, it never repeats, but it does rhyme. History tells you that the market doesn't bottom until after the first Fed rate cut. Not the pause, not the, last hike. It's after the first cut. And even then, it's quite a ways after. It's almost 9 months after. So, again, if you think that the first cut isn't until the first part of next year, like us, you're probably looking at a true bottom probably sometime in 2024.
Well, that does make sense based on how history has acted. On the other hand, we could go back a year and a few months, and I could say history says that stocks go up in the first year after the Fed starts hiking rates. and until earnings peak, usually the market can keep climbing. So I guess the counter to that was, are we out of step with the cycle as his historical patterns would tell us?
Yeah, no, it's a great question. I think you have to look at valuations, right? If you have valuations that are cheap enough to where you can overcome some of the things that, maybe history says aren't all that great, fine. But the tricky part is right now you're trading at almost 20 times earnings, and that's peak earnings. So you've got a market that's still, counting on 2023 coming in around 220. So pretty much right in line with last year. And you've still got the market paying close to 20 times on that peak earnings number. The tricky part is there's just no margin for error for this market.
And so, aside from preferring fixed income at the moment, within the stock market, are there places to get some shelter?
So I think you can still participate within kind of the larger cap, higher quality areas. We actually do like tech, energy, and healthcare. So, some of the pullbacks in tech and energy should be viewed as an opportunity. We also recently added to developed markets. We took it from a most unfavorable to a neutral. We think as the year progresses, people will view kind of the world outside the especially developed markets as being just as high quality, but trading at some really nice, attractive multiples. I go back to what I said a few minutes ago. If you can get those valuations in the low teens like IFA trades at, that to us means that you're at least getting paid to take the risk while you wait.
Gotcha. Samir, appreciate the update. Thanks so much.